The more you have of something, the less rare it is. And the less rare something is, the less we consider it to be of value. That is why precious metals, which cannot be created or destroyed but only transformed in shape, have stood the test of time as money. On the other hand, the reckless printing of more currency inflates the money supply like a balloon, making it less valuable per unit. Additionally, the velocity at which individuals pass that supply around is what raises prices. Today, on HowToFinancial, we're discussing the money supply. Gold, silver, platinum, and other precious metals are very rare when compared to, say, aluminum. This is why we value them, for their rarity and durability that can last a long time, and why our founding fathers in the USA demanded that the money supply be tied to them. They knew that every country that had ever used a money supply that wasn't tied to precious metals had eventually failed. In a gold-backed currency system, the amount of money the government can spend is restricted by the amount of gold it holds in reserve. The government cannot simply print more money as it can in a fiat currency system. Instead, it must acquire additional gold to increase the money supply. Additionally, since the value of money is tied directly to the price of gold, if the government were to spend money excessively, it would likely lead to inflation and a decrease in the value of money. This, in turn, would decrease the purchasing power of the currency, making it more difficult for the people to acquire the goods and services they need. Therefore, a gold-backed currency system provides a natural restraint on the government spending, as the government must consider the availability of gold before spending money. This helps to maintain the stability of the currency and prevent excessive inflation. Let me explain. M0, M1, M2, and M3 are monetary aggregates used to measure the money supply in an economy. The value of currency in a gold-backed system would be directly tied to the price of gold and would fluctuate based on changes in the supply and demand of gold. M0 refers to the most basic measure of the money supply, and it includes only physical currency in circulation, as in notes and coins. In a gold-backed currency system, M0, physical currency in circulation, would consist of physical gold, coins, or bullion and paper notes that are redeemable for a specific amount of gold. The amount of M0 would depend on the amount of physical gold held in reserve by the central bank and the amount in circulation. M1 is a measure of the money supply that includes M0 and near money. Near money refers to savings deposits, checking deposits, and other time deposits that can be quickly converted into currency. M1, which includes M0 and near money, would consist of all physical currency in circulation, which is M0, and all deposits in gold-backed checking accounts that can be quickly converted into physical gold. The value of M1 would be directly tied to the price of gold and would fluctuate based on changes in the supply and demand of gold. M2 is a broader measure of the money supply that includes M1 and near money as well as far money. Far money refers to money market securities, certificates of deposit, and other time deposits of a larger size that are less liquid. In a gold-backed currency system, M2 is typically calculated by including all physical currency in circulation, which is the M0, as well as all deposits in gold-backed checking and savings accounts, certificates of deposit, and other time deposits that are easily convertible into physical gold. M3 is a measure of the money supply that includes M2, M1 plus near money, and the large denomination time deposits, institutional money market funds, and other large liquid assets. M3 is considered a broad measure of the money supply and includes most of the money-like items that are included in M2, as well as additional assets that are less liquid and less easily convertible into cash or other monetary instrument. Now I can hear you asking, isn't more money better? Why don't we just print a bunch and give everyone a raise? First, we have to understand inflation. Inflation, quite simply, is the measurement of the money supply and its circulation velocity. Velocity refers to the frequency at which a unit of currency is used to purchase goods and services within a certain period of time. In the context of the money supply and inflation, velocity is important because it affects the relationship between the money supply and the price level. When velocity is high, it means that money is circulating quickly through the economy and being used to purchase goods and services at a fast pace. This can put upward pressure on prices and lead to inflation. Conversely, when velocity is low, it means that money is circulating slowly and not being used to purchase goods and services at the same pace, which can put downward pressure on prices and lead to deflation. As a countermeasure to either too high or too low of inflationary or deflationary velocity, the central bank will often raise or lower interest rates in an effort to encourage or discourage borrowers. But they really don't want the common citizen to know this, as it can stymie their efforts by further changing the velocity. To avoid this, central banks often use terms like quantitative easing or quantitative tightening, which are nothing more than terms used in a hope that the layperson won't catch on. And that's pretty insulting to our intelligence, but it unfortunately works if you don't have a financial education, which, let's face it, is why you're here. This will either speed up the velocity of the economy or slow it down. But it does so at the expense of the value of the dollars that are already in existence. As an example, follow me on this vicious cycle. If you were to elect politicians based on promises to print free currency to distribute to all, and if they were actually able to get anything done, they would arrange for the government's central bank to fire up their printing presses and print more dollars, which would then be handed out to everyone in an effort to make people richer. Those people would then spend that money in an effort to raise their lifestyle on luxury items, for example, a new boat. This currency would then go to the businesses that built the boat, but at a raised price. This is because the businesses' suppliers raised the prices of the initial commodities they make their products from, like wood, timber, oil, plastics, metals, etc., to maintain these commodities' value in relation to the value of the dollar. This is because the amount of dollars has increased, while the amount of the commodity, in this case trees, has stayed the same. So every tree is worth more dollars. So now prices go up on all items made from that commodity. And the individual cannot afford those goods and services, so they need more money, leaving us right back where we started, and we may as well have never printed any more money. But now, things are actually worse because the companies that the citizens work for have also had to raise their prices in order to maintain profitability. So they don't raise the salaries of their employees in an effort to maintain those profits, which now have less value. Their employees' hard-earned paychecks and subsequently every dollar they have ever saved in the past look identical but are now worth less in value compared to the money supply. The unintended consequence is that in an effort to make people richer by giving them money, you have actually made them poorer, which results in the average individual, who is usually not very educated, financially speaking, blaming businesses for raising prices but not their employees' incomes, instead of blaming the central bank who increased the currency supply or the politicians who encouraged them to do so. So we elect new politicians who will give us more currency to help us, and so the cycle starts over. This is called inflation, and in this manner, the money supply eventually becomes worthless. The harsh reality is that inflation is a zero-sum game in which we all lose. But possibly even worse than inflation is deflation. The deflationary spiral, also known as the deflationary cycle or deflationary trap, refers to a situation in which a decline in prices leads to a decrease in demand, which then leads to a decrease in production and a further decline in prices, creating a different vicious cycle. The deflationary spiral can be triggered by a number of factors, including a decrease in the money supply, a decrease in an aggregate demand, or a decrease in velocity. When prices fall, consumers may delay purchases in the expectation that prices will continue to fall, leading to a decrease in demand. This decrease in demand can lead to a decrease in production, which can then lead to higher unemployment and lower wages, which can further decrease aggregate demand and lead to a further decline in prices. The deflationary spiral can be difficult to reverse and can lead to long periods of economic stagnation as businesses and consumers become reluctant to spend money and invest in the economy. In order to escape the deflationary spiral, the central bank may need to take actions such as increasing the money supply, lowering interest rates, or implementing fiscal stimulus to boost aggregate demand, thus causing a reinflation, as we described before. This delicate balance between inflation and deflation is all caused by a lack of tying the money supply to precious metals, and this is known as fiat currency. Proponents of fiat currency argue that the ever-increasing population demands that we increase the money supply so that everyone can have enough. This ignores the unintended consequences as described in our section on inflation and is what results in income inequalities between business owners and employees. Instead, we should focus our efforts on having a precious metals-backed currency and increasing the supply of those precious metals at a rate equal to the growth in population. The California Gold Rush, which lasted from 1848 to 1855, was such an event that allowed America to increase the supply of precious metals, making the value of the dollar higher, and therefore the printing of more currency during those years would not have devalued the dollar. But like all good things, it didn't last, unlike our printing of more currency, and as a result, the value of the dollar has been declining ever since. And this was made even worse in 1971 when the President, Richard Nixon, took America off the gold standard. Between the end of the gold rush and 1971, there was a steady decline in the dollar's value, but since we went to a fiat currency in 1971, inflation, income inequalities, corporate profits, and a whole host of other unintended consequences have soared. Thank you for watching, and make sure to like and subscribe for more great upcoming content. Comment below on what you'd like us to discuss in our next video.